You probably heard about the Reddit IPO, which instantly soared from $34 to $50 when it debuted at the highs last Thursday. And then it jumped another 30% today. It's closing at just under $60. Now, look, I'm not as interested in this one, given that Reddit's a 19-year-old company that's both unprofitable and cash flow negative, but it has had a monster run. Ka-ching, ka-ching. But last week, another IPO was kind of intriguing. I'm talking about Astera Labs, which makes connectivity hardware for data centers, exactly what you need for the fastest cloud setup, or better yet, AI. And thanks to the AI connection, this one came in hot. Astera Labs priced its IPO at $36 per share, way above the initial proposed range. And then the stock opened at $52 and change last Wednesday. If you got in on this deal, you instantly made a 46% gain. It didn't stop there. The stock gained ground every day, climbing another $15 to $85 today. That's a 21% move, for heaven's sake. The stock's now more than doubled, up 136% from its IPO price. Like the old days. This kind of rally is terrific for anyone involved. But I do hate to see it because it tells me that the stock's probably already overheated. We don't want an IPO market that's too hot because that means there's too much speculation. Speculation precedes a real big downturn every single time. Long story short, Astera is clearly positioning itself as a new way to play the AI theme. They even name-dropped NVIDIA in the prospectus, though it's unclear what their exact relationship is. Astera Labs says that it's one of the hardware companies that's going to benefit as we rebuild data centers all across the world for the more advanced computing needs to be in the AI era. That's true. To be fair, they're probably right. But even if you take Astera's claims at face value, I still take issue with the valuation because this thing exploded right out of the gate. It's going too high. When you dig deeper into the financials, it's hard to justify paying up too much for this one. The best thing I can say about Astera's numbers is that they've got good sales growth, up 45% last year. But, man, when you look at that rough share count, this is now valued as a $13 billion company. That's well over 100 times last year's sales. By comparison, NVIDIA sells for 39 times last year's sales, and it had 126% revenue growth. So, if anything, it should be more expensive. Plus, NVIDIA is immensely profitable, not Astera. But you can't value Astera Labs on earnings per share because it doesn't have any. Last year, they had a net loss of $26.3 million. When you strip out all the stock-based compensation expenses, that loss does shrink to $15.6 million. Still not great. Meanwhile, Astera's burning cash, negative operating cash flow last year. They burned through $12.7 million during that period. Don't get excited about that.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.